Good morning, traders. This is Chris Buss with Traders Profit Compass with a morning look at markets for Wednesday, September 16th. Okay, we've got the FOMC September statement that comes out at 2 o'clock. So what I'm going to do this morning is go over some Fed-sensitive asset classes, and then we'll get into the indexes and the FATMAAN names. New acronym, I guess everybody's using, so I'll get on board with that. Before I get into the charts, I want to go over quickly some things that are going on in our mentorship group. We had a meeting last night, and our typical format is to, simply check in with the traders just to see what's been going on in their trading and how it's going, stuff like that, before we, get into the meat of the discussion. And we had a couple traders last night that were kind of defensive because they hadn't really been doing a lot of trading over the last couple of weeks. One of the guys has a medical issue in his family that he's helping out and attending to. And the other gentleman works from home in his real job, which has been busy. And he's got a couple of kids in grade school that have just started their fall term with virtual learning. So, they're at home in front of the computer, and they're young kids, so they need to be, their hands held while they're supposed to be in front of the screen and, paying attention to whatever's going on in the classroom. And that's a burden. That's a real issue when you're at home and, you have your regular job to tend to and the kids to tend to, and, and then there's trading. And I said, hey, there are going to be times when it's simply not appropriate to be trading. If you're distracted, if you've got family priorities, those always come ahead of trading, because no matter what you say or do, when you close that door to your trading room and you sit down at the trade desk, you bring whatever's happening in your life to the table. And if you got one eye on the screen and one eye on the kids and half a brain trying to trade and the other half who knows where, you're just going to end up trading poorly and get more frustrated. So realize that while trading is important, if that's how you want to spend your time and you want to excel at it, that's great, but other things come first. And you're not doing anybody any good by trying to trade when you're distracted with more important things. The market gives opportunities every day. Those opportunities will be there next Monday, a month from now, or a year from now. So don't think you're missing out on anything, because you're not. Everything will be there when you come back. We'll all be here to give you a hand to get back in sync with the markets. So take care of business first. Let trading be second. And then when you come back, you'll be fresh and ready to go with your mind totally devoted to the task at hand. So anyhow, never be defensive about stepping away from the trade desk. Okay, let's get into the Fed and kind of what's going on. Here we've got the Euro US dollar currency pair. And even if you're not a big currency guy, and I'm not really, I may trade the US dollar here and there, but it's not really a focus of my work. But that said, I keep a close eye on things, because they say if you get the US dollar right, everything falls into line. And you can see here that since March, the euro has exploded off of this 109 pivot up to this one between 117 and a half and 119. And I haven't shown it here. I have shown the chart on the blog post this morning. If you want to go over there and check out the weekly, this trend line goes back 10 years. So this just isn't a line, from 2018 to now. It goes back to the great financial crisis. And you can see how important this line has become in the last month or so. It has not been able to punch through 119, but you can see this flagging formation, that it certainly looks promising from that standpoint of, it has not been impulsively rejected. It's flagging here, consolidating under this resistance. If you see the euro US dollar pair pop 119 and even get through 120, which is a big line of support and resistance that goes back 20 years. If you see that pop and the euro start to run, which means the dollar is falling, that's going to be a tailwind for gold. That's going to be a tailwind for commodities. And it'll probably be a tailwind for equities as well. As the dollar becomes cheaper, it's better, for exports and stuff like that. So this is a massive level to keep an eye on. And of course, if Powell were to say something that somehow strengthens the dollar and this comes down, gold's probably going to have a hard time, making a strong advance if the dollar is strengthening. And we've seen recently on days where the dollar strengthens, equities in general haven't done so hot on those days. So keep an eye on the euro US dollar pair and watch that 119 level, and then watch 117 and a half for a breakdown if it gets rejected. Moving on to bonds. Here we've got TLT that has been in this trading range between 160 and 172. Aside from the whipsaws of the March COVID, 172 and 160 has contained price. Now, I'm sure you've heard all the chatter about, inflation. We're going to let it run hot. We're not going to, raise rates forever. And so there's this narrative out there that inflation is going to be rising, and that would mean rates are rising, and that would mean TLT is falling. The only problem is the FOMC hasn't been able to engineer 2% inflation for 10 years. So the idea that, quote, they're going to let it run hot, they haven't proven that they have the tools to make that happen. They can hold down short-term rates, but that's about it. So, but if you do see rates starting to rise, that's going to push TLT down. And you can see that at this 160 level, below that, there's a massive, massive air gap below where volume over price really falls away until you get down here in the low 140s. So I would set an alarm at 160. And, that's also a level where you could do an objective long, at the bottom of the value range, and where you'd expect that to hold. But if it doesn't, you can, you can flip bearish right away, and see if it can lose this 200, and after that, you might see a freight train heading south on TLT, and that would be a nice directional move to capture. And if rates hold, I mean, this is 160 is a great place to be long. So that's an important juncture. And you can see right now that price is kind of in the middle of the range. Let's go down to the 60-minute chart because it kind of shows a different picture. We've had some choppy action in the last month or so. And although it's not perfect, you've got the makings of an inverse head and shoulders. Now, if Powell says something today where rates drop, if there's a rate move lower based on what he says, maybe he says something like, we're tempering our economic outlook, or it's gotten worse since the last time we made a presentation. You might see rates drop and TLT rise, and above this 164.70, it's got room to run back up towards this neckline around 167. So if you see a move, in the next day or so, above this 164.70, I mean, even call it 165, that might be a nice long trade against this level and look for a move back up to 167. Then if 167.5 were to be taken out and take out this neckline, the projected move is back up here to the top of the range at 172, and that would be a big risk off move, and that may be accompanied with an equity sell off. So these things kind of move in tandem. So if you see rates cratering and bonds jumping, that's a move to safety. That's a risk off move, and that's something you want to, even if you don't trade it, be aware of. Let's move on to the banks. And all the talking heads have been talking about piling into banks, and it's only this percent of book value, and it's extreme value and all that stuff. From what I can tell, the facts on the ground just don't support getting long banks. It's the opposite. This is the banking index versus SPY. So as this ratio falls, it means banks are underperforming SPY. And you can see here, the ratio is testing the lows. If they were to make a move lower from here, you can see this as a bearish flat flag. Here's the impulsive move down. Here's the flag. If it breaks this support right here, we could see a significant move down in the banks and financials in general. So this is a good one to keep on the radar. Everybody talks about JP Morgan as, the cream of the crop, the best there is. And they are. They're the biggest and one of the best banks, big banks. Got this big triangle. Giant bearish engulfing candle yesterday, down 3%. It got up to the 200 and this downtrend resistance and was smacked down yesterday right down to the bottom of this narrowing triangle. And the reason this is important is because it's running out of room. You know, as this coil tightens, there's either going to be a massive breakout where it jumps above the 200, which is something, you know, you really want to be on board. If this pops the 200 out of this triangle, it's got a lot of room to run to the upside. But should it break below, then it's below all the moving averages. Here's the 50 in green. You know, if it moves below and loses this 97.5 level, you know, then it's coming down. It may not come down to the, you know, March lows at 77, but it's certainly not a place where you'd want to be long if this thing breaks down. So, you know, as far as alarms go, the 200 is at 103. You're not going to miss anything by setting an alarm at 104 to avoid any kind of head fakes. Because if that breakout is for real, that dollar's not going to make any difference. You can get long against the 200 and then hold on for a ride higher. But if it loses the 50 and loses 97.50, I think you got a good short on your hands. And I didn't include it here, but go look at Citibank. I don't know the whole story there, but they've lost 12% in the last 2 or 3 sessions. And, you know, basically look horrible. I mean, these are the biggest institutions that we have. And when you start seeing 3% down moves when SPY is green, something's going on. And if you don't want to, you know, play individual banks and that kind of thing, and just want to take more of a sector view, we've gone over this chart on the weekend reviews, but this is XLF. That looks like a double top to me, and it looks like, to my eye, that 2450 is your key level. That's just below the 50. If you see price lose 2450, I think you got a fast move down to 2250, 10% lower, a $2 move. That would be a move that you want to participate in. And yeah, so set yourself an alarm at 2450. And you know what? If it holds in your bullish banks, that's an objective long right there against this support. So that's a key level, 24.5. Also, I don't have it shown here, but look at KRE, the regional bank index. That has a big triangle as well, and that one is already broken. So that's on a daily sell signal as we speak right now this morning. So take a look at that, and you know, there's a strong likelihood that, you know, they're going to react either positively or negatively to whatever, you know, Powell says this afternoon. I don't think there's, you know, any rush to get in at, you know, 15 minutes after the statement. Let it settle out. I think the direction will be clear, and then you can take a position either long or short. SPY is up this morning. It seems like it's a risk-on morning. This 342.50 has been key. That has rejected the last 2 tries. If SPY can pop 342.50 and hold it, your next upside target is 345. And if down the road in the next few days, if they can take out 345, the bulls will have cemented their control in the short term and have an open door back to 349. Now, if they pop above and then lose it, then that's a short as it comes back into this prior trading range. And then another key level is 340.60. That's where the gap was. Yesterday, they took a look below. They did not fill the gap. And then they, bounced it into the close. So if they turn it around on Powell or just, general market movement, if they lose this 342.50 and then come back down and enter into this range of 340.60 back into this gap, then you're looking at a target of 338. Same kind of idea with the Qs. This 280.25 has been a sticking point going back to this prior run at that level. If they can break that 280.25, then you've got a gap above from 282 to 283.50. And if they were to pop that, then your next target is 286. And by the same measure, if they break it above and it gets rejected back below 280, then the natural target is this 277.70. I know I don't have that marked, but that's your level here for this gap. You can see that yesterday it came down to tag it where it bounced. This level here for the gap is 277.70. And if it were to enter that, then your target is the bottom of the gap at 275. IWM yesterday was trading up at this 154.5 level, pulled back, and in that late day dump yesterday fell below this 153.70. And I think it's above here in the pre-market. So as long as it can hold 153.70, I think you can be long and look for a push to 155. If they can break above 155, then they're back into this upper trading range. And I think your upside target on a breakout above 155 is this 156.50 area. If it falls back below today, then your target is 152. If it were to break above and then fall below, you can get short then against 153.70 and look for 152. Facebook, I'm sure you've heard by now, possible antitrust suit potentially being served against them. So you may see that trade soft today. But let's say it doesn't. If they can break above 273.20, and it's been, rejected here a couple times. If they can break above that level, then your target here is up towards 278, 278.50, and there's still an open gap to fill up to 282.50. If for any reason we lost yesterday's low here at 270, then you're looking at, a move down towards, I would think, 265, 263 if it lost this pivot at 270. So that's a good line to shoot against. As long as it holds this 270, you can be long. But you really want to see this 273 level go to the upside for, more or less a $5 move. Apple, They sold their event yesterday here at 118, and it came all the way back to 114 where it found support. I think you can be long against this, 113.75 level. Let's see, what was the low? 113.61. Call it 113.50. As long as it holds that, you can be long for a run up to 118. But you really want to see 118 pop, and then you got a $5 path to 123. But I'd be real concerned if it lost this 113.50 level, because then you're coming back towards 110 if Apple stays soft. Amazon just kind of thrashing around here. I still think the key level is 31.50. Below that, you've got $50 to $100 a downside. But if it can pop this wedge, then you've got basically $50 to $100 of upside, up to 32.50. The real move, if it can take out 3,200, then 32.50, you can get $100 higher, up to 33.35, and that would be, your key level to kind of put all this chop behind it, and then back up, towards the highs of 3,400, 3,450. But first things first, it's got to break the wedge, get through 3,200, then get through 32.50. There's some work to do there. And if things fall apart below 30.50, I think you can be short. Microsoft didn't do a whole lot yesterday. I think as long as you're above this wedge and above, 207, I think you're fine on the long side. But it's gotta get up towards this 213 to take it out, to get your, $7 move, $8 move up to 221. You'll see some resistance here. I don't have it marked at 216. But as long as this pivot here at 207 holds, I think you're okay. If you see a move back down below 207 and things start falling apart, then you're looking at 204 and lower if that breaks. Google hasn't really done anything. 1538 is your level. You can be long above and short below. Really hasn't shown, any real power either way. Actually, probably more of a bias to the short side. But unless the market breaks down, I doubt you're going to see this thing fall apart. Probably just chop around. But, as long as 1538 holds, I think you can be long if you really want to trade it. I think there's probably easier ones to trade than this right at the moment. But if you're comfortable with the stock and, familiar with it, knock yourself out. Netflix has been a nice tradable stock recently. We had the breakout out of this falling wedge, gave an opportunity to get long here at 485, gave you another opportunity here at 490, 495. I think as long as it holds this level here at 494, you can stay long and look for 505. If it were able to take out 505, then you're back up to 520, which is a key level. If it can take that out, then you're looking at a run back up to the highs. Of course, there's a lot of work to do between here and the new highs, but all I'm saying is, level by level, stay long against 494, If it can take out 505, you can move up your stops and stay long and look for 520 and just ratchet your way up until, price gives you an indication that, it's going to be rejected at one of these levels. Now, of course, there's always the flip side. If it loses 494, I think you're coming back to 485 pretty quick. And then if 485 fails, you're coming back to the lows towards, 475, 465. So, that's how it goes, level by level. As long as you hold it, you're fine being bullish. But if you lose it, then you've got to turn your attention to the downside and where those potential targets may be. Tesla, massive gap and run higher. Kind of had an exhaustion move at the end of the day. Bulls are going to want to see this 450 level held, the close of yesterday, and certainly the low down here at 440 on that candle. I think you can be bullish against 440 if it went down there, or 430 here where this gap is. But under 430, I don't think you want to hang around long, too much into this gap. That may signal a rolling over. It all depends on where you got in yesterday. If you got in, early, you gave some back, but you can still stay long. And today, if you're an active trader and you see price take out 460, that can be, you can set your stop just below and then see if you get, a push up to 500. I think that would be an objective trade, taking out yesterday's high, setting your stop just below, and just, staying on it and see if you can get that push right on up there. And, it's shown it can move, $50 in a day. Be careful right at that 2 p.m. announcement. If you had a bunch in the bag, at 5 minutes to 2, you may want to take half off ahead of Powell. Anything can happen, and don't get hung out to dry on something, that Powell might say at 2 o'clock. I usually, if I'm active day trading, I step aside for Powell. You're going to see a massive, the potential. Even though nobody expects him to say anything material, if he does, you're going to see that whipsaw both up and down. And, if you're sitting there with weekly options and it decides to go down, you can get wiped out in 15 minutes. So be careful heading into that 2 p.m. Announcement and then the press conference at 2:30. Just kind of gauge where you're at and see how much, exposure you really want to have out there when that happens. Okay, let's wrap it up here. I hope you found the content helpful this morning. Please hit the like button and subscribe to the channel if you're new. That would be great. And check out the show notes. I've got a lot of links there where you can subscribe to my content and get this stuff in your inbox every morning, and links to the blog. There's a lot of information there, more than I can fit in a video. So check that out. There's additional charts, additional commentary that you might find helpful, and a lot of info in the trading psychology tab for aspiring traders at all levels. So I hope you have a good rest of your day trading. This has been Chris Buss with Traders Profit Compass. Talk to you next time.